Okay, awesome. Well, it's quarter after. I'll go ahead and get started. My name is Jeffrey Kennedy. I am the editor of Traders Classroom at Elliott International. I'm also the Chief Commodity Analyst at Elliott International. Thank you for joining me today. I'm sure you guys are exhausted. This is the last day, the last hour of the event. So thank you very much for showing up. I've got business cards in a lot of the seats. Grab one if you'd like. I feel like one of those guys on the corner. So let's go ahead and get started. Why am I here? I'm here to give you a very gentle introduction to the wave principle. And the way I like to do that is to start off with a few slides. This is who I am. Again, just what I said, Traders Classroom, commodity junctures, been looking at those markets for years. And I like starting off with this. The limits of my language are the limits of my universe. And the reason I like starting off with this quote will lead us into today's topic of what the wave principle actually is. Does anybody understand this? Can you read this? You can? That's the first time. Okay. Okay. My point is, I do not understand this. I cannot read or speak Mandarin. Okay? I'm impressed. How about this? Does anybody understand this? Electrical engineer, possibly? Okay. Well, I don't. Again, I don't understand that. I don't understand this language. How about this? Does anybody understand this? Okay. Again, I don't. I don't understand these languages. Which brings us to technical analysis, what this whole week has been about here. Technical analysis is a language. And the more you understand the language of technical analysis, the better, I believe, you'll understand the narrative of the markets. Now, having said that, technical analysis is really an umbrella term. It encompasses many different exciting fields. For example, Japanese candlestick analysis is a type of language. The wave principle is also a type of technical language. Point and figure analysis is a type of language. So what I'm going to be doing today, again, is to give you a very gentle introduction to a specific language or dialect, and that is the wave principle. Why bother? Why bother with it? Why learn this language? Because I think this language will offer you some benefits that other technical tools simply do not offer. For example, the wave principle, in my opinion, allows you to identify confidently the direction of the primary trend in any market. It allows you to identify counter-trend moves within that trend. It can kind of give you an idea of the maturity of a trend, whether a market is topping out or bottoming out. We use, as Elliottians, Fibonacci ratios, retracements and multiples extensively in our work to identify objectives for waves. And that allows us to identify high confident objectives utilizing Fibonacci ratios. And also, too, it allows me to identify quite specifically, quite precisely, where I'm wrong. Where, like, hey, I might be looking at cocoa and I might have a wave count and I might be bullish cocoa. Well, if I see certain price action, I can just say, okay, hey, I'm totally wrong on this. But with such precision, I can identify to the pip, tick, or penny when an interpretation is no longer viable. So these are the benefits, in my opinion, of the wave principle. So I encourage you to actually maybe take a second look at the wave principle if you have already and maybe discarded it. Or if you're new to the wave principle, I encourage you to continue to learn more because I do believe you will find value in it. I specifically get into its application, not just from a forecasting perspective, but from a trading perspective in my book that I wrote with my brilliant co-author, Wayne Gorman. Wayne Gorman, if you ever have an opportunity to meet him, he doesn't get out publicly that often, but he is wicked smart. He truly is. He's one of the few people in the world that can still teach me something new about the wave principle that I did not know. and I could not be more proud or happy to have him as a co-author on this book. So if you'd like to learn more about the wave principle, not from an analytical or forecasting perspective, but from an actual trading perspective, entries, exits, that sort of thing, you may want to take a look at the book. So we're going to start off with basic Elliott. So what exactly does the wave principle do? The wave principle gives you a context for viewing price action. Like for example, head and shoulders. When I say a head and shoulder top formation, does everybody understand what I mean by head and shoulder formation? Okay, and what happens if you break the neckline of a head and shoulders top? What? You're going down where? Neckline measurement. Okay, then what? Okay, a lot of your old school patterns will give you a direction, but they'll just simply give you the next move. Many of the wave patterns I've been working, like for example in the commodity markets, and some of you have been longtime subscribers to Commodity Junctures, know I've been utilizing the same wave counts, like for example in sugar. That wave count we've discussed in the sugar market, I've been utilizing that for over a decade, okay? So again, the wave principle gives you, I think, a bit of an edge. It gives you the ability to look up, look down, and see what the larger context. And the way the wave principle actually does that is it classifies price action into two very specific modalities, motive waves and corrective waves. There are two types of motive waves. There are three types of corrective waves. Everything else that we know about the wave principle originates from those 5 core patterns. And here they are. What we have over to the left, upper left-hand corner, this is an impulse wave. 5-wave move up, waves 1, 2, 3, 4, and 5. Also, too, it's important to mention that the wave principle is fractal. Does everybody know what I say by fractal? Okay, let me just clarify. A fractal is a self-similar pattern regardless of scale. For example, 1 mile of coastline looks like 100 miles of coastline when viewed from space. These patterns that we work with as Elliottians, they build larger and smaller versions of themselves. So within wave 1, you can see a smaller 5-wave move. And within that initial move up, you'll even see a smaller 5-wave move. So these 5 core patterns build smaller and larger versions of themselves that we call Elliott wave patterns. Now going back to the two types of motive wave patterns, you have the, again, impulse wave here, then you have the diagonal. Then we move on to the corrective wave patterns, and we have the zigzag, the flat, and the triangle. So you've got 5 core patterns. Again, everything else that we know of the wave principle originates from these 5 core patterns. Now these patterns do have some variations and complexities. For example, a variation of a flat, 2 types of variations to a flat pattern would be the expanded flat and or running flat. So it does get a little bit more complex, but as far as the basics, this is where it starts. Now, when I first began learning the Elliott wave principle, and this was back in 1993, I started at Elliott wave in 1993, and I was really good. Give me a line diagram like this, and I could count the hell out of it, okay? It was real easy to see the line diagrams. But when I was confronted with an open, high, low, close price chart, that's where I was just like, okay, I'm not really sure what's going on here. The transition from looking or identifying these line diagram patterns on an open, high, low, close price chart was quite challenging for me. So I've got some examples of what these patterns actually look like on an open, high, low, close price chart. Now, the problem I just described, are any of you having that problem if you're looking at the market from an Elliott wave perspective? A few of you? Okay. What I recommend is simply put on like a 5 or 8 period moving average on your price chart. A lot of times that will slow price action down and it will cut the noise out. A line chart will still simply be too noisy. Even though R.N. Elliott, whenever he developed the wave principle back in the late 30s, 1930s, he utilized a close-only chart. But if you take an open, high, low, close price chart and put a 5 period or maybe an 8 period. 10 might be a little bit too long, 5 might be a little bit too fast, so somewhere in the middle. Experiment with it, play with it. A lot of times that can take the noise out and it'll kind of focus your eye. So that's a tip. Or you can use a channel, moving average channel. Like say a 5 period moving average, a simple period moving average of the high and the low. And then that way also too, you can see those waves evolve a little bit more clearly.
I remember she said questions after.
I'm sorry?
Questions after, I thought.
No, this is, it's a small group, and I've got time, I've got the room. I bought the room for the night.
You said apply the 5 moving average to help you clear out the noise. Well,
Yes.
my issue is like, it seemed like Elliott seemed to care about almost all of price action.
What do you mean?
Like it seemed like in validation levels, like if a wick was to like wick past a certain validation level, say like a wave 1 come down.
Okay, he's talking wicks. Does everybody know what a wick is? The proper term, by the way, is shadow. Steve Neeson, he says shadow. Candlestick price charts. When it comes to counting Elliott waves, I do not recommend utilizing candlestick price charts because a lot of times your vision will lock in on the real bodies and you begin to ignore the shadows. And those shadows, that intraday high, that intraday low, it's very important from an Elliott wave perspective. So if you're going to count, if you're going to apply this tool, this language, utilize open, high, low, close price charts. Do not use candlestick charts. Similarly, I've seen a few articles in the past on applying Elliott to like point and figure charts or what's another style of chart? Not Heikin-Ashi. Rinko charts. Be careful with that. Does everybody know the difference between, say, a Rinko chart and a point and figure chart and an open, high, low, close chart? Sir? Yes. Exactly. Rinko charts and point and figure charts, they basically eliminate time. It's all price movement. Price movement is what governs whether something forms next or does not form next. But you're exactly right. I'm not that good with point and figure, so I don't use it. Rinko, I really think that if you're going to utilize Elliott, you really need to look at the an open, high, low, close chart because the time is important, especially because R.N. Elliott talked about one of his guidelines being the guideline of proportionality. That's very important. So I think the time component is very, very important. Okay, so let's go on and take a look at some examples. Now these I think are fairly good, say, almost textbook examples. That's why I selected them. This is just a straight impulse wave. Waves 1, 2, 3, 4, and 5. That's what an impulse wave looks like. An ending diagonal. That's what an ending diagonal looks like. It's a 5-wave move that overlaps. That would be wave 1, wave 2, wave 3, wave 4, and wave 5. Each of the impulse waves here would subdivide into 3 smaller waves, specifically a zigzag. Old school technicians would refer to that as a rising wedge. And whenever we see something like this, it tends to lead to a sharp resolution to the downside back to below the origin of the pattern. Zigzag. It's a 5-3-5 pattern. Here's a tip worth writing down. Hint. Price action contained within parallel lines tends to be counter-trend. And a zigzag fits that structure quite nicely. So what we have here in Apple, 3-wave move down, parallel lines. Specifically on the subdivisions, that is a 5-3-5 pattern. So it qualifies for a zigzag. Flat. A flat is a 3-3-5 pattern. 3 waves in wave A, 3 waves in wave B, followed by a 5-wave move. Here's a really good example of flat. Of a flat in goose. And as a corrective wave pattern, what do we know? Correct? Okay, everybody. I thrive on audience participation, so if I don't hear some answers, I'm going to start calling on people here. A corrective wave pattern is a counter-trend price move. That's all it is. So if you see a correction, at some point you can look for that move to be more than fully retraced. Can anybody tell me what Goose closed at today? Come on, people. We've got all this technology. Anyone? Goose. Ticker symbol, G-O-O-S. I just call it Goose.
It's on 64.42.
64?
Yep. 64.45. 45, yeah.
So 64. So we're up here.
It was up 10%.
Okay. So we're right here, say roughly 65.
Yeah, we jumped.
Okay.
Which is right.
Okay. I put together this chart a couple of weeks ago in preparation for this seminar. And thank you. And the reason why was because I was like, I got to go to Vegas. I need some good examples. What can I find? I do this service called Trader's Classroom. I don't know if I talked about Goose in Trader's Classroom, but it was just like, hey, here's a really good example of Goose. Now, who of you are like old school technicians? Edwards, McGee, and Bassetti. Oh, I actually met Bassetti one time. Who has that book by Edwards and McGee? Technical Analysis of Stock Trends. Awesome book. It's kind of like the Bible for technicians. I didn't really notice this, but after a while, if you have that book, there's a third author on the book, on the spine of the book, Edwards, McGee, and Bassetti. And a few years ago, I was in San Francisco at one of the IFTA conferences. I was speaking at Golden Gate University, and I give my presentation pretty much very similar to this, technical analysis as a language. And this gentleman came up to me, very dapper, and he's like, I wish I could speak like you. And I was like, it was such a compliment, because that group is really industry experts. It's kind of like my peer group. And I was really taken back by that. And he introduces himself, and he says, my name's, blah, 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 Mr. Bassetti. And I sit back in my chair to listen to the other speakers, and I'm like, Bassetti. And then it clicked. It was just like, oh my, it was like, it's really neat when you can meet your heroes, or it's really neat being in this industry and meeting the guys that have been in the business for 20 or 30 years, or 40 or 50 years, like Ralph Alcampora. It's just, these guys are legends. These guys started it all. But no, really good example of a flat. But also, too, the reason I talk about old school technical analysis is don't be afraid to learn more than one language. It's useful to be bilingual, okay? For example, how many of you are familiar with a closing the price gap trade setup, or the significance of price gaps? Who knows what a price gap actually is? If you know what a price gap is, raise your hand. Where's the price gap? Between the open and the close? No, that's not the price gap. That would be the real body of a candlestick chart. Right here.
Yeah,
That's a gap. That's a price gap. Okay? Well, it's not uncommon for price gaps to provide support at some point for subsequent price action. Now, it's kind of a misnomer to claim that all price gaps are closed. I don't find that to be the case or to be the truth. But whenever I see a price gap on a chart, I pay close attention to it. Familiar with the term double top? Most double tops you see in a market are basically the origin of wave A and the extreme of wave B of a flat pattern, a flat Elliott wave pattern. Point I'm trying to make is the wave principle is a technical, is a language, again, a form of technical analysis, but it works quite well with Japanese candlestick analysis. It works quite well with indicators and oscillators, momentum analysis. Case in point, does everybody know what a key reversal is? Raise your hand. You know what a key, well, you know what a key reversal is because you learned it in my service. Other people, do you know what a key reversal is? Okay, a key reversal occurs whenever you have, like, say, today's price action. What's today? Wednesday? Okay, I fly back tomorrow. Okay, a key reversal would occur if today, a bearish key reversal is if today we make a new high in trading above yesterday's high in trading, but we close below, today we close below yesterday's close. It's a new high followed by a lower close. Got it? Okay, a double close key reversal is basically a little bit of the same. I make a new high above yesterday's high, but I not only close below Tuesday's close, but I also close below Monday's close. Now, add another component, outside bar. Okay, I make a new high today above yesterday's high, I make a new intraday low below yesterday's low, and I close below Tuesday and Monday's close. That is a double close key reversal outside bar combination. I love bar pattern analysis. Okay, why is that significant? Okay, well, Steve Craig, he's the editor-in-chief of the Pro Services Energy product at Elliott Wave International. And I tease him, he needs to write a book, he'll still see this video and I'll get nasty emails. Why did you do that? But he's brilliant. He's been in the oil business his entire life. In fact, one summer when he was in his teens, he worked on an oil rig. He knows the energy industry, hands down. And we were looking at crude oil because I talked about crude oil in the weekly wrap-up for commodity junctures. And it was, I believe, a few weeks ago, we're looking at this, I'm like, hey, it looks like we have 3 up in crude. And then on the monthly chart, we have a double close key reversal, outside bar. And everybody knows what's happened in crude oil since. Point being, the wave principle, I do not recommend utilizing the wave principle in isolation. Use it with other stuff. Technical analysis is a very rich and diverse field. It offers a lot of wonderful tools. Think, how many of you would go to a buffet and only eat one item? Okay, then simply, as a technician, don't rely on a single tool. And the wave principle is an excellent tool that I strongly encourage you to put in your trader's toolbox. So let's look at some more stuff. Here's a triangle. Here's the other pattern. Oh, pop quiz. We're going to have fun, and I'm going to run late. I don't care. What's this? Okay, you don't get the answer because you know this stuff. I'm going to pick on you because you're front and center. What's this? We just talked about this. 5-wave move, impulse wave, exactly. And this is how you would look at it or break down its actual structure. Waves 1, flat 2, 3, zigzag 4. And kind of the giveaway on a flat is wave B ends at or near the origin of wave 1. Okay, what about this? Got it? Who said ABC? Okay, my students can't answer this. What do we have here? Is this an impulsive move where the market is really showing conviction, like the bulls are in total control of the market? Is this a bearish move in which everybody's like, sell, 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 sell? What do you have here? Counter trend. It's sloppy, it's choppy, it's slow, and it's contained within parallel lines. Again, please write that down. It works. Sir.
I have a question in terms of your language analogy. And what I'm wondering is that in a certain way, are you saying that the market is an individual that is trying to communicate with us and we're using the tool to interpret it? Or are you saying that we have what originally looks like chaos and we're trying to bring some system to it to have some idea of what could be next?
Wow. That is an awesome question. I wish I had a beer. No, really. No, that is something that we could sit down and talk about for an hour over dinner. You bring up some really good points. And I don't know if I'm going to be able to answer that, but I will share with you some of my observations. Because I've been in the business for 25 years, and compared to many people, that's half the time that they've been in the business. But I've been looking at some of these markets as the chief commodity analyst. I've been looking at sugar for 15 years, and I have come to believe that individual markets are just like people. Like, for example, I love Thai food. Some people don't like Thai food. Some people like to go outside. Some people like to walk around in the city. I've really come to believe that individual markets have their own nuances, their own little idiosyncrasies. In a lot of ways, they're like people because they have their own personality. Like, for example, currencies, the way currencies trade. Individual stocks don't trade like currencies. Now, there is a similarity between the way currencies trade and the way commodities trade. So I suspect they're kind of like cousins almost. So you bring up some good points. The reason I compare technical analysis to a language is for me, it's education. The more I understand about technical analysis and the different ways to interpret a price chart, the more clear things actually become. And so when I ran across that page of Mandarin, it's like, I don't know what the hell this means. Why? Why don't you know? Because I don't know the language. I don't have the education. But with practice and training and a tutor, I can learn. And with that knowledge, I can look at a price chart and go, hey, I know what's going on here. Yes.
So for example, when we talk and we have language back and forth, there's certain patterns that we recognize and almost anticipate what happens next. When you see a chart and you bring your language ability to it, do you then have something that says out of those 5 patterns that the likelihood is that the next thing is going to be a declarative statement, or it's going to be a question, or it's going to be in any of those 5 patterns and what a percentage is that it will come out that?
Okay, yes. Yes. Okay. I can look at a price chart, for example, goose. Okay. To me, that was a declarative statement. Toward the end of today's presentation, I'm going to share with you my favorite Elliott wave-based trade setup. And you'll also see how, in my opinion, that was a declarative statement at that time. There are times when I'll look at a price chart and I don't know what it's saying. The wave patterns are not clear. My advice, and I teach this to my subscribers, if you can't count it, don't trade it. It's quite simple. Don't force it. Okay? I like things simple. I like things clear. And from a trading perspective, if it's not clear, I avoid it. With so many individual stocks out there to trade, with so many markets, financial markets, U.S. and all over the world, there's going to be something out there that's clear, that's not going to be, that will not afford you the opportunity to misunderstand. Okay? So we'll move on. Slow, choppy price action, this is nothing more than a counter trend move. So which brings us to real markets, real time, and real money. Okay? What do we have here? Does anybody, okay, now when you're looking at this, don't be Alice in Wonderland. And when I say Alice in Wonderland, fall down the rabbit hole where you look at this and you get lost in the structure. You're like, okay, I don't know what label that is. I don't know what wave pattern that is. I don't know what degree to put here. I don't know if I should put a 1, a 2, a B, an X, a W. I don't know. Don't do that. Step back, okay? An impulse wave consists clearly of 5 waves. 1, 2, 3, 4, 5. If it's not a clear, clean 5-wave move, odds are it's going to be a correction. What are some characteristics of counter trend or corrective price moves? We've already talked about this. What are they? You weren't taking notes, were you? Choppy, sloppy price action contained within parallel lines. 9 times out of 10, that's going to be a counter trend move, and it's going to be 1 or 2 of the types of Elliott wave corrections we discussed. Zigzags, flats, or triangles. That's why we have something called a double zigzag or a double 3 or a combination. So let's just keep it simple. We're going to try and start off on one of 2 feet. Is this price action motive wave price action? Think of it as a logic tree. You look at a chart. You see price action. Okay? Question number 1. Is it motive or corrective? If it's motive, I've got 2 choices. So is it an impulse wave or is it a leading diagonal? They both have 2 totally different types of characteristics. A diagonal is a wedge shaped. Okay? Well, if it's not motive, then it's going to be corrective. Okay? Well, what kind of correction is it? A zigzag, a flat, or a triangle? Well, a triangle is going to be a sideways affair. A flat's going to be a double top or a double bottom. Okay? So you work your logic tree. So rather than get into exactly what pattern this is, just tell me, is it motive or corrective? Corrective. Raise your hand if you say corrective. Okay, raise your hand if you say motive. Okay, we have to talk. Again, tip. I've almost built a career on this, guys. Counter-trend price action, slow and choppy, tends to be contained within parallel lines. The answer is, it's a correction. Basically, I have two corrections here. And this was a bond trade that set up quite nicely. This was the correction. This is what we were looking at. And because it was a counter-trend move, my understanding of the language, it was quite clear, quite decisive, quite unambiguous what was going to happen. Okay, now, can we count this? Sir, what do we got? You're a student, you don't get to go.
I have no
John,
idea.
you no idea?
No idea.
Okay, if you're going to, okay, well, hold on, let me run with that. John does not know. Okay, so what's John going to do from a trading perspective? Are you long or short?
I'm probably short.
He's probably short, but he doesn't know. Is that smart?
Well, you got the parallel lines and the long.
Well, hold on, let me run with this. If you don't know what's going on, it's okay to not have a trade. You can be long the market, you can be short the market, and you can be out of the market. And sometimes being out of the market is the smartest trading decision you can make. And there are many times I wish I had been out of the market, okay? If it's not clear, stay away from it. If you can't count it, don't trade it, bottom line. So I was having fun with you there. It was a good set. You set me up. Okay, so what do we have here? The best way to eat an elephant is one bite at a time. Okay? So you section it. You focus on what you do recognize. And maybe that will give you a hint or lead you into an answer on the rest of the chart. For example, let's start at the high and work down. What do we have? Top to bottom. What does that look like? What do we got? 5. Okay? There you go. You're Elliotticians. What do we got? 3. Awesome. Okay, perfect. What's a 3-wave move? Is it a motive wave or a corrective wave? Okay, as a corrective wave, it's going to be counter trend, right? So that means this is going down. Does everybody agree? Everybody agrees. 5 down, 3 up. Yes? Up from here to here? Yeah, I can certainly come up with 5 of that. I encourage you, though, as an speaking from practical experience, don't get lost in the mirrors. Okay? Lean back. One of my mentors, Dave Allman, gave me a tip a long, long time ago, and he recommended something called the brush stroke. I was looking at the markets and a lot of time looking at price action, and I was getting real OCD about it. I was like, okay, well, that's 1, this is 2, or maybe here's 1, and that low of that bar is A, and that's B, and then that's C, and then I did that. I drove myself crazy doing that. Okay, lean back. You have a decisive move. It's not slow. It's not choppy. This took some time. Down, up, down, and then you had your move up. Clearly a 3-wave structure. 5 down, 3 up. So, just with that bit of knowledge, what kind of forecast can we make in this market? Down. Does everybody agree with that? Does everybody see where I'm coming up with that? 5 down, 3 up. I'm going down. Okay? Now, the only question I have is Am I going down? So here's the count. 1, running flat 2, 3, flat 4, 5, A, B, C. Okay, so what forecast can we make from this assessment? The market's going down. So really the only question we have is this. We're either going to sell off in wave C, 5 waves, or we're going to sell off in wave 3. So that's really the only question I have about the question. The direction of the market is quite clear. Okay? How the market unfolds, is it going to be a C wave or is it going to unfold in 5 waves? Now, if it's going to unfold as a C, here's some tips. Okay? Well, if this is a 5-wave move for wave A, typically what we see in wave C is a more shallow slope. This isn't in the book if you want to write it down. It's a good tip. When you're working a zigzag, the slope of wave C, more often than not, will be more shallow than what was experienced in wave A. If you're working a flat correction, then wave C, oftentimes, will be steeper than the angle of ascent or descent of wave A. So that's a nuance. That's something that you basically pick up after years and years of looking at charts and counting waves till you're crazy. So if this is a C wave that I can anticipate coming down, then the angle of that decline should be less than what was experienced in the initial sell-off. Now, if the angle of decline forthcoming is steeper than the initial 5-wave move down, then odds really begin to shift in favor into the idea that this is a 3rd wave sell-off. Okay, that's what unfolded. That's what happened. And this was a real trade.
So what you're saying between the two in terms of the flat being steeper, when you're looking to do a trade and you're looking to say how much profit or how much distance I have going, is the steeper slope indicating that, is it talking to you and saying, no, we're not stopping at an intermediary, we're going further than you may have thought if you were going with the shallower slope?
Can you say that one more time?
Let me put it this way, shallow slope versus steep slope.
Okay, okay.
What's the indication in terms of distance of correction?
Okay. As far as distance of correction, okay, you bring up 2 questions. 2 really good points. Thank you. He's participating, guys. Example, okay. When you have a zigzag or have a flat, the most common relationship we tend to look for between C and A is equality. Same for the zigzag, same as a flat. Which brings up another question. I don't view counter-trend price moves as high probability or high confidence trading opportunities. So I tend to leave them alone. And the reason why is because it's a counter-trend price move. My style of trading is I'm very much of a trend trader. I don't like picking tops. I don't like picking bottoms. A trade for me is like a party. I like to arrive late, and I like to leave early before the cops come. I want to see, it tells you what kind of parties I like to go to. Cops are coming, time to go. But no, I like that confirming price action to confirm that my assessment is indeed correct. And a lot of times, if we're moving into a Friday and I've already taken a position on Monday and I'm up 40%, I'm gone. And I'm looking for my next opportunity. So I don't use counter-trend moves as trading opportunities. They basically are my opportunity to rejoin the trend. So I like to focus on wave 3, wave 5. If I've got 5 up and done and it feels good, and I've got, like, for example, in crude, a double closed key reversal outside bar combination, or a bearish engulfing pattern, or an evening star at the top, then yeah, I'll look at possibly taking a sell side position in that case. So that's the way I like to play it. The trend is your friend, and honestly, I have no doubt every one of you at one point or another have bottom ticked or top ticked the market. Haven't you? Okay, we all have at one point. But can you do it day in and day out, week in, week out, month in, month? No, and I don't know anybody who can do that. Okay? Now, my eyes were opened whenever I was reading a lot of Jack Schwager's book. I'm a huge fan of his. Stock Market Wizards. Have any of you read his books? Okay, if you have not read his books, shame on you. You need to go out and download on Audible his books and listen to them while you're on the treadmill at the gym. You need to read his books. And the reason why is because what Jack did was he interviewed the best of the best of the best, the world traders in the world. And once you read their stories, you'll learn a lot about emotional discipline, individual psychology, the importance of risk management, and understanding the importance of trend. And that's what really opened my eyes. Excellent, excellent books. Big fan of Jack's. This was a real trade right here, by the way, in the bond market. I'm sorry?
What was his last name?
Schwager. S-C-H-W-A-G-E-R. Jack Schwager. Market Wizards. Stock Market Wizards, Commodity Market Wizards, Currency Market. He's got like 5 or 6 books. Any of the Market Wizards books are phenomenal. They truly are. Another pop quiz? Okay, now I asked you this question before. You missed it. Okay, she says it's an impulse wave. Who agrees? Yes? Yes? My lady who speaks Mandarin does? Okay. Yes. Okay. Unfortunately, I appreciate your audience participation, but you're wrong. And the reason why is because wave 2 terminates below the origin of wave 1. Each wave pattern has its own set of rules and its own set of guidelines. One of the cardinal rules of an impulse wave is that wave 2 may never retrace more than 100% of wave 1. Wave 3 may never be the shortest impulse wave of waves 1, 3, or 5, and wave 4 may never end in the price territory of wave 1. You cannot violate those rules. This is how the wave principle allows me to identify to the pip, tick, or penny if my interpretation or if my analysis in any market is indeed incorrect. So, this is not correct. Okay, why am I beating this point? Because if you use a tool, regardless of what tool that is, you must understand its rules and guidelines and follow them. How many of you drive cars? Okay, this might sound funny next. Okay, how many of you would put diesel gas in your regular car? Okay, if you have an automobile that runs on regular gas, it's kind of a rule that you don't put diesel in it, right? You follow the rules. If you don't follow the rules, it will hurt you in life as well as in technical analysis. Yes?
Does number 1 become number 2?
No, probably what happened in this case here, that's 3, 4, 5, A, B, C. But it's not an impulse wave. There will be another count. But point is, I see a lot of Elliott out on the internet, and I see a lot of bad Elliott out on the internet. And the reason why is because the practitioner is simply not following the rules and the guidelines. If you're going to utilize the wave principle, and I strongly encourage you to take a look at it and learn the language, but also understand the importance that at the end of the day, the wave principle is nothing more than a tool. And you must learn how to use and wield that tool properly. For example, a knife is a tool. Who would agree with me on that? Okay, a knife in the hands of a skilled surgeon can save lives. A knife in the hands of a lunatic can take them. Learn your tools, learn how to use them well and properly. That goes for the wave principle, that goes with candlesticks, that goes with anything that you're learning here this weekend or this week. I know we're kind of running short on time. Let me show you my favorite trade setup. Okay? As an Elliottian, I'm always on the look for this. This is my setup. This is my go-to move. I'm in many ways kind of a one-trick pony. This is a 5-wave move. This is Navistar. Okay? You see the 1, 2, 3, 4, 5, A, B, C. This is clearly wave 3. It's the longest wave. It's the sharpest move. Within a 5-wave move, wave 3 is the one where you go, wow, man, look at that market move. Okay? Either to the upside or to the downside, doesn't matter. Wave 3 if you're wondering, if you're looking at a price chart and going, maybe that's wave 3, it's not. Okay? Wave 3 is that price move that you can look at it and go, dude, that's wave 3. There's no question. That's a third wave. Those are exciting to me because I know the market is going to digest that move. It's going to pull back, and all I have to do is be patient, like a wildebeest. Well, no, like a lion. Looking for a wildebeest. There we go. Like a lion in the Serengeti Plains, man. I'm looking for the baby wildebeest. I'm just waiting in the grass. Yes?
So what you're saying is that wave 3 is so prominent that when it takes place, it's just smack you in the face.
Absolutely.
Volume,
It does.
parabolic.
You know that there's about to be a correction of
Yes.
wave 4, but you're not playing that.
Exactly.
Basically, you're saying you want a resumption of the trend to take you up to 5, which is going to take you about 3.
Bingo.
And that's your prominent,
That's my favorite trade setup. And the reason, again, to reiterate a number of the reasons why I don't like to trade counter trend moves is because how many motive wave patterns are there? 2. Okay. How many corrective wave patterns are there? 3. Okay. But there's also something called a combination. Whenever a market moves too far, too fast, one correction is insufficient in digesting the move. For example, I'm a little bit of a gym rat. If I run a mile, it might take me 3 minutes to recuperate, maybe 5. But if I run 5 miles, I'm going to sit on my butt for about 20 minutes, okay? So the farther a price move goes, a lot of times the more time it needs to actually correct or digest that structure, okay? So what you might have ABC for a zigzag, and then you have an X wave, and then you can have, you could have a double 3, you could have a double zigzag, you can have a combination where you have a zigzag, X wave followed by a flat, or things might actually get crazy where you have, say, a 3-wave move down with a triangle X followed by, they can be messy. But even though they can be messy, the personalities do not change. Slow, choppy, corrective price action contained within parallel lines. Hold on just a moment. Okay, my favorite trade setup is to look for a wave that is undeniably a third wave. Then to be patient and look for wave 4. And then once wave 4 is in place, I hit it. I hit it hard. As a buddy of mine would say, he crushes it. And so in this instance here, that's 5 up. I mean, that's waves 1, 2, 3, that's a 4. Come back to the center line of the base channel. That's a 3-wave move. A, expanded flat B, ending diagonal in C. I'm loving Navistar at this point. And I wrote about this in Trader's Classroom, my service. And it took off like gangbusters. Love it. Now, if you go back and take a look at Navistar now, we've finished the 5th wave move, and we're now pulling back in 3 waves. So as we move into December and January, I'm back to watching Navistar again. Yeah.
What time frame do you mainly use? Daily charts, or do you use all sorts?
That's an awesome question. Thank you for answering. What time frame charts do I use? Okay. Well, it depends on what my trading horizon is. If I'm doing really short-term day trading stuff, like maybe a 3-day hold period, because I do a lot of options trading, then I'm probably looking at 15-minute, 60-minute price charts. But for like the 401k, I want something I can like buy and not mess with. I'm looking at daily, weekly charts, primarily weekly charts for something like that. Like Walgreens Boots Alliance, ticker symbol WBA. I talked about that in Trader's Classroom about 6 months ago as far as a nice move to the upside, probably going to take out the 2015 high.
Now, futures, in futures, you mentioned earlier that each market has their own characteristics.
Yes.
And it seems like some markets, especially the futures market, have certain elevate patterns. Like the yen, it seems like, but yet corn seems like you consolidate breakout. We go with copper, so it's like.
Okay, a lot of information there. Yes, individual markets have their own personality. For example, I get real frustrated trying to trade gold on a short-term basis. It's like if I day trade gold or short-term trade gold, I'm looking at 15 or 60-minute price charts. I can't touch it without at least having a $1,500 stop on that sucker because they'll run it. Okay, bonds, I like to trade bonds quite a bit because bonds, it seems like they're more well behaved. Yeah, I like the flow of the bond market. I don't see these erratic spikes or stops in the bond market that as I do in the gold market. Yes.
So with what you just said in terms of languages and the like, the give an analogy in terms of your workouts. And you understand that in terms of a 1 mile run, you have a 3-minute recovery, and therefore if you run longer, you're going to have a longer recovery. The parallel to that is that when you come to a fourth wave where you're hitting from a third to a fourth, you basically are gaining more patience because you are saying this could be a 1 mile or a 5 mile run and it needs more recovery. But once that recovery is over, fifth wave is on its way.
Yes.
Is that a fair
Oh,
parallel?
absolutely. No, absolutely. Absolutely. And it's time specific. If I'm counting, say, a 5-wave move, for example, if these price bars here, well, that's me. Okay, this is a 2-day chart. Each price bar represents 2 days worth of trading. Okay, if this were a 15-minute or a 5-minute price chart, then I would be looking for this move to here to last just a few hours and be done. But because this is a longer-term chart, I'm looking for that advance to, say, last for 3 to 4 months. This allows me to really distinguish myself. Am I a trader? Am I a day trader? Am I a swing trader? Or am I an investor? This is, again, why I think the wave principle is a phenomenal tool for you if you're a trader, or say, hey, I do 3 or 4 trades a year. I used to know a copper trader out of, where? Milan, Malta? Oh, Monte Carlo. He was basically kind of a market maker, and they would take 1 or 2 trades a year, but they were the market. They were just massive. And then they would write options on their positions, and they had great income. Yes.
Can I get those in rules on when wave 4 is done?
Well, one of the things I like to see is, I like to draw a trend line from the top of the move against the highs. So a trend line from that high here across that peak right there. Once we got above that line, boom, I'm good to go. Again, I don't like picking bottoms or tops. I want to see confirming price action. Why? Why is that so important? Okay, a lot of your questions really today, and thank you very much for them, really kind of illustrate quite accurately a parallel between markets and real life. They truly do. For example, we all have cars, and we all know not to put diesel gas in our cars, right? Okay, so I'm driving down the road, okay, and here's my intersection. Car's coming this way, but I'm looking to go this way. Here comes a car, and its blinker is on. Its right-hand turn signal is on. I see the car, I see the blinker, and I'm going, okay, cool. I pull out in front. How many of you do that? How many of you do that? Okay, I see everybody shaking their damn heads. Exactly. I live in Florida, okay? You don't ever do that, okay? My father would drive down the highway for 30 minutes with his turn signal on, okay? So what are you looking for from that car, that 2,000-pound hunk of steel? You're looking for the car to, in technical terminology, that language, to decrease its momentum. And then you're looking for the car to commit. You want to see the wheels of the car begin to turn. Only then do you have sufficient confirming price action that the car is indeed going to turn and not T-bone you. At that point, you feel safe that you can now pull out. Why trade any differently? Yeah.
Wave 4 for your favorite setup, quite often fours are complicated and they're very hard to interpret when I look at them. So I've looked at trying to catch the beginning of a wave 3. In your estimation and with what you've seen, which would be the harder of the two? Trying to get in after wave 2 is complete and catch the wave 3? Or is it easier just to look at the wave 4 and catch the wave 5?
Okay, if you're looking to capture the wave 3s, understandably so, because 3s were the big price moves. I love 4s because a lot of times over here, I may be thinking it's a third wave price move, but it could turn out to be a C.
That's what happens often, I get stopped out.
Exactly. So, but fourth waves, there's something called a truncation or a failed wave. Okay, truncations are actually very rare. A truncation occurs whenever a wave that should make a new price extreme fails to do so. They're very, very rare. So in this situation here, it's like, I know I'm covering this distance and then some. High probability trade, 80, 90%. You're definitely going to take out that high. So,
The wave three really is you're working against yourself, you're better off just taking the 5 and having a higher probability.
well, no, there are some clues. There are some things that you can look for. For example, one of my favorite trade setups would be, like, for example, right here. Number one, draw a line from here to that high, come over. Okay, you break that trend line, then you come back down and test the upper side of the trend line. Beautiful giveaway. Double failure swing high, double failure swing low. You know what I'm talking about? Okay, I love that. That's like, again, one of my go-to type trade setups. Also, too, when I was talking about the angle of ascent and descent, if this were indeed an ABC, you have this slope of that wave 1, then your slope in wave 2. Well, once you see that, it's not a C wave anymore. This is going to be a third wave. A lot of times on this smaller structure, a way to identify a 1-2-1-2 is both corrective wave patterns will be the same type. So you'll have, like on the 60-minute, this mess here. A lot of times what you'll see is like 1 zigzag 2 followed by another 1 followed by another zigzag 2, or 1 up flat 2, 1 up flat 2, or 1 up expanded flat 2 followed by another 1. Because what that does is that eliminates the opportunity for alternation. So there are clues. And again, those clues come from, and understanding those clues just simply come from practice, 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 practice. And reading the books and taking my service. So, but yeah, I wanted to show you, I love the fourth way trade setup. It's my go-to move, truly is. Questions?
How much of all this is in the book?
A good portion of it.
The basic stuff.
The basic stuff. Oh, well, there's 2 books I would recommend. Number 1, Elliott Wave Principle by